Hi, I'm Steve Van Metre. Welcome to your Monday night premiere, where we take about 15 minutes every Monday and Wednesday night, probably longer on Wednesday, but we'll see, to discuss what's going on in the markets that, well, right now seem to be lost without any direction from the Federal Reserve. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by selling a security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity opinions expressed in the video that do not reflect the view of Alice Financial Advising Inc. or Steven Van Metre Financial. Just wanted to get that out of the way at record pace. So anyways, we got the Fed meeting coming up Wednesday, so expect nothing out of the markets tomorrow. I mean, they are going to be as benign as possible, and I'll show you in the trading volume, if we have time today, that investors are literally just sitting on their hands. And there's a problem, as I think I was a bit off on a tangent on Friday, went a little long, 40 minutes, but the market is running out of liquidity, and what you're hearing from the markets is not what's really going on. They're begging the Fed for a rate cut. It's no different than a kid begging his parents for some more candy or another scoop of ice cream. It's the same idea. Investors are way off the cliff. The stock market is in the wrong position. If it was in the correct position, you wouldn't hear them begging for a rate cut. You say, go ahead, raise rates. We don't care. They're begging for it. I'm going to show you why. So let's just jump right into things and see where we go. We've got, starting out, the Nasdaq Summation Index. And again, I really like this because it's telling us that liquidity in the markets is low. And it's been hovering right around this roughly minus 300 point. When it starts to fall below zero, which it has been for sometime mid last week, I want to say, or all last week could possibly, because I'm not zoomed in here. Anyways, it tells you liquidity is drying up, and when liquidity dries up, markets fall. And so you can tell it's this minus 300 range, right? Somewhere in here is where markets need to find a rebound. And so far, it hasn't. It's just kind of sitting there, setting up a move that if the Fed doesn't give the markets what it wants, maybe even if it does, that things are headed lower. Now we'll come back to the hedge fund positioning. I want to get through some of these other charts. Let's take a look at, this is a great chart posted on zerohedge.com today, and it shows volatility from bond, stocks, and currency. So you can see that bond volatility is taking off. Now, bond volatility is a little different than stock volatility. When bond volatility goes up, bond prices go up. So what this is telling you is bonds are saying that, hey, things in the market are wrong, and look at stock volatility, it's really low. And what it suggests is that stock volatility needs to be at the VIX index, which is sitting at roughly around this 15 point here, needs to be up over 40. And then you can see currency or FX volatility is also low. It too needs to rise. So volatility is telling the markets that, hey, stock investors, you're in the wrong place. And stock investors know that, hence why they're begging the Fed for liquidity. Now, granted, it's really important to understand that even if the Fed eases, and I hope they don't, and I'm going to show you why. And it's not a personal issue. I just don't think that we'll get to that. Is the markets are wrong. Stock investors know they are taking risks they shouldn't. They have not added any. They're over leveraged. They have no portfolio insurance. Things like U.S. Treasury bonds or long volatility positions. They are kind of running off, Wile E. Coyote off the cliff, looking down, going, uh-oh, I need the Fed. I need a bailout. I need liquidity. But even if the Fed gives it to them, there's minimally an 18-month lag, minimal 18-month lag before the rate cuts hit the market. It's going to make no difference. Look, that's what happened in the last two recessions. This is the same thing that repeats over and over and over again. The market flies too far off the cliff. Investors look to the Fed. The Fed, sometimes they give it to them, sometimes they didn't. Now, they did in October 2007, and it didn't starve off the recession. Why? Because the monetary lags. It's the same story, except investors don't remember. All right, let's take a look at this. Corporate profits are not looking that great, and yet investors are clamoring for stocks, earnings and corporate buybacks and profits. It's like, well, there's no profits there. They're declining. So that's not very helpful. But here is the big picture. You have U.S. stocks, you have central banks pumping the global money supply, and the macro data is as bad as it's been. I mean, we're somewhere today I read that the global macro data's downtrend is one of the longest in history, and yet the stock market's sitting near all-time highs. It doesn't add up. You can't have both. You can have one or the other. So either the macro data needs to rise, and I'm going to show you that it's not, or the stock market needs to fall. And according to this, the S&P 500 needs to drop 700 points. And if it does that, you're talking a massive amount of mispositioned investors trying to unwind. It's going to just wreak havoc on the market, especially with all these computer-controlled programs. Now, why is this situation not going to get better? It is not necessarily because of the tariffs. It's because of something called world dollar liquidity. And I've written about this and talked about this before, but world dollar liquidity is a function of foreign-owned U.S. Treasury bonds, and you can get around in the monetary base. Now, we know the Fed is tightening or reducing the monetary base. So there's a very simple solution. You take the monetary base and add it to the foreign-owned Treasury bonds. So if the Fed is reducing the monetary base, the simple solution is foreign investors need to buy more Treasury bonds. But guess what happens? They tend to not do that. Or if the Fed is raising the monetary base, well, then foreigners can sell their Treasury bonds without much worry. So here is the latest data from the U.S. Treasury that came out today. Major foreign holders of U.S. Treasury securities, they dropped $40 billion last month. Now, where's that money going? Well, the large U.S. banks are buying it. Some foreign investors are buying it. But generally, you're seeing these are largely central banks. They are selling their U.S. Treasury bonds, meaning world dollar liquidity. Now, we don't get the world dollar liquidity data but every quarter, and it's late. I mean, it's very, very late. But what this is telling us is that world dollar liquidity is going to continue to be in contraction territory, and that means you can forget tariffs and all that other stuff. It just means the global economy is going to be in the toilet until the Fed stops unwinding the monetary base, which they're not planning on doing until the end of September, or until foreigners start buying U.S. Treasury bonds. But the problem is foreigners need dollars to buy U.S. Treasury bonds. Where do they get dollars? From trade. See, it's a self-licking ice cream cone. It really is. When the machine is turning the way you want, it works. But when it goes the other direction, it's bad. And it takes somebody to step up and change it. Will we see that on Wednesday? Maybe. The other problem is even if the Fed does a rate cut, they're still unwinding their balance sheet. The two don't make any sense. So the odds are the Fed probably will do nothing, as I suspect that they will. We'll see. But here's going to be my argument of the Fed doing nothing. This is personal consumption expenditures. This is the Fed's gauge for inflation. This is what they look at. Now, I've drawn a line at 2%. This is the target the Fed wants. The Fed wants inflation to hit at 2%. Now, let's zoom in, and you will see since the great financial crisis ended, there was one time in 2012, and I guess here just briefly in mid-2018, where personal consumption expenditures got to 2%. They've been behind it. Now, all of a sudden, the market investors are telling the Fed, okay, you need to cut. You haven't hit your inflation target. Well, why didn't they cut here? Why didn't they cut here? Cut here, cut here. Why now? But look at the trend. The trend is certainly rising. I mean, it is a rising trend. So there, even though this is at 1.56, and my guess, my prediction, I think this comes out tomorrow. I'm not 100% sure, but it does coincide with the Fed means, is my guess this goes up, and the Fed does nothing. I mean, that's going to be my prediction, is the Fed stands pat. Now, I've got an article written by, or that was presented at a recent Fed meeting that will blow your mind about what they're planning on doing. I mean, it's the leading direction of what the Fed is going to do during the next recession, and it will scare you. But we'll talk about that on another update. All right, so let's carry on to what the hedge fund managers are up to, because this is really, really interesting. Now, one of the challenges is with these reports is they are not to be used as a timing mechanism. But I did spend some time this weekend looking at them, trying to figure out if you could come up with an idea of what a timing mechanism could be. And I'll show you why I came up with that. So when we look at the 10-year Treasury yield, we can see that hedge fund managers, the dumb money, are still short. Now, they're not as short as they once were, but they're still short. And all that tells us is they are betting on rising interest rates during a period of monetary decelerations and a period when world dollar liquidity is contracting. They are mispositioned. So when they decide they want to be correctly positioned and they want to buy bonds and take a long position, yields are going to crash. And that's why if you own U.S. Treasury bonds, you are in line with the smart money, as I've been writing about recently. Now, looking at the 30-year yield, check this out. The dumb money went long here. And this is very, very, very important. And here's why. If we go back, say, to 2016, and you can see, let's say here where they were short. Well, let's just see where they changed direction. Let's just go with that, where they went from long to short. That was right here where roughly this purple line is. It yields at 2.7. So they shorted, or they brought yields were down, and they were mispositioned. They were correctly positioned by this point as yields fell. But what happened is the smart money started taking the opposite position here. So as you see here, the hedge funds went short right here, and the smart money, if we could see them, was long. But where was the breakout? The breakout was roughly around 2.6% on yields, which indicates as the smart money was buying bonds, and you can see how it shoots straight up here. So what does that tell us with 30-year yields? Well, it tells us, let me flip over to the 30-year yield chart so you can see that. It tells us what we need to do right here is change the color of this to green, because what this means is the smart money is starting to take a short bond position. I'm going to get this backwards, but I'm going to try to keep it straight. The smart money is taking a short bond position. Now, if the smart money is starting to take a short position, that means they're hedging their longs. It doesn't mean they're dumping all their longs and going short. It means they're hedging that, which means if the smart money wants to make a profit at some point in the future, they believe that yields are going to go above 2.6%. And what's really cool about that, if you read the same paper I did from the Chicago Fed this weekend, you would get it. And you go, I see why that is eventually coming. Not immediately, but why it is coming. And the smart money is starting to build their position here. Very, very cool. Looking at oil, which traded down slightly after trying to rally in early trading. You know, people have trouble believing me when I say oil is going to go way, way down, because demand is falling. We're near 2-year highs in inventory. Tomorrow we get the API. Wednesday, before the Fed announcement, we get the EIA data. What's going to happen at some point as inventories continue to build, when all these hedge funds decide to dump their oil? They're going to crash the market. That's what's going to happen. They're going to crash the oil market. And it's going to bring stock prices down with it. And so now we see the dumb money is long the S&P 500, as we've seen there for a while. We're not going to talk about Euro futures, gold. It looks like the dumb money is going for the fence. Remember, I said we're looking at a pattern that this rolls down and over. Still consistent here. The Nasdaq, the smart money is short. The Russell 2000, this is the one place that the smart money is mispositioned. It looks like they are taking a long position here. So maybe that tells us that the Russell 2000 is going to lead the market back up. That might not be a bad position during the next downturn that we should see. And the US dollar, we're seeing dollar longs from the hedge funds community, the dumb money, start to diminish. And that means the smart money is taking, again, opposite position. Of course, we have volatility, which is set to skyrocket. Of course, we know the smart money has been buying volatility all through here, and they've let some pressure off of it, but they've been buying volatility for the last 2 years, and that is significant. All right, let's see. Let's look at some charts anyways. Doesn't really matter if we go a few minutes over. Actually, you know what? There's something I wanted to point out. Here we go. Crop conditions, the USDA is misreporting this. People that are crop experts are saying they're way off, so I'm not even going to bother going over that. But look in the next 6 to 10 days, massive cold front. I know at least my wife would be happy about that, rolling through western United States. But look at this, lots of rain, as we already knew was coming in the Midwest this week, and another rainstorm starting in the Northeast coming across this way. And remember, the watershed zone is east of the Rockies, west of the Appalachians. So as this rain hits over here, it does flow down to the Gulf of Mexico and cause flooding. Now let's look at the 8 to 10 days. So going out another week, we see a nice cold zone. That's going to be wonderful. But look at this, still rain, all above average rain flowing right through the Midwest. Not good for farmers at all. All right, on to some charts. Maybe this will run about 20 minutes. We'll see. S&P 500 doing nothing, just sitting up here above resistance. Everyone's talking about S&P going higher, higher, higher. If the Fed is generous, I don't know where all this money on the sideline is sitting. Where they're getting this opinion is from the U.S. Treasury market, and what investors are expecting is people to go running and dumping their Treasury bonds, driving interest rates up, and using that money to buy stocks. As we've looked at, the major banks are buying bonds, so they're unlikely to sell them, especially with foreign investors selling them. Someone's got to buy them, and that's why the major banks are buying them. So I don't think that narrative is going to happen, but I'll be surprised if the Fed cuts without stopping their balance sheet unwind, because it doesn't make any sense. Looking at 30-year Treasury yields, same thing. These are sitting off a cliff. I've got the portfolios ready to roll to increase the duration risk on this. It makes sense. This is a bull market in bonds. And when we see a plunge in liquidity, we should expect to see interest rates head back to their all-time lows or pretty close to it. And we look at the 10-year Treasury yields, it's sitting at 2, and it only doesn't have far to go, and 0.5% gets it near its all-time lows. And then with that, let's wrap up with ag commodities, which are looking at a 1-year chart, are kind of getting close to their 1-year highs and just closed over their 200-day moving average. Here's resistance. And as they pull through here, that gets some momentum up to the next level. And again, all these are short positions that people are shorting this sector. And so hopefully that will continue to push up a little bit higher, especially because looking at the bond volatility, now that I'm thinking about it, look at the U.S. here's the ETFs. Here's the 7 to 10-year ETF, just ready to rocket higher. It's sitting right over its resistance level, forming support. Looking at the long bond, it's bouncing in between a mild resistance and support level, looking to take off. Bonds are going to steal the show, folks, and I can tell you, most investors are not positioned for it. All right, so Wednesday, we'll have the update from the Fed. I will be closely watching that, and I will be ready to give you an update, and we'll see. Will the Fed be political and bow to President Trump? Will they be independent and not hike, which would be based on a political move? Will they look at the economic data that their own Federal Reserve member banks have pushed out to say, hey, things aren't as bad as investors think? Or do they bow to the stock market? Once again, it'll be interesting to see what they have to say. I'm Steve Van Metre. See you Wednesday night.